Hello and welcome to Moneycontrol. Well, the market seems to have digested pretty much the budget yesterday itself. It lost all the lost ground yesterday, and today it's trading a little higher. To decode the budget further, we have a very important market voice, a market veteran, Neelkanth Mishra, who needs absolutely no introduction. Thank you so much, Neelkanth, for joining me this morning.
Thank you, Mahalakshmi, for having me here.
So first off, I'm going to ask you straight away about the one thing that everybody has been talking about since yesterday. Why this tinkering with the capital gains tax? What is your take? Does it change the complexion of equities going forward in terms of, returns versus other asset classes,
No, I think
particularly real estate?
So the objective of this whole exercise was to rationalize tax rates. So there was, I think, unduly complex mix of what is long term, what is short term, varying by asset class. There was, some tax, some long term capital gains tax at 20%, some at 10%. So I think the changes to short term and long term and fixing them at 20% and 12.5% was, I think, seen as important because there was very visible distortion in the flow of savings. So savings have been, flowing disproportionately into equities, I think the reason, and if you think about the equity risk premium, it was so low that it made sense to actually buy government bonds. But the fact that that was not happening was, I think, primarily because of differential taxation. So I think the objective of this whole exercise was to reduce the distortion in savings or flow of savings caused by differentials in tax rates. So that was the purpose. The apprehension some people had was that this 10% on equity capital gains would go to 15% or 20%. But very wisely, the government has brought down the long-term capital gains tax on other sectors from other asset classes from 20% to 12.5%. So this is, in my view, a relatively minor change. Remember that equity capital gains taxes are paid only if you have, wherever you have highest equity capital gains is where you will pay some tax. So if you're making 10% returns, earlier you were getting 9% post-tax. Now you'll get 8.75% post-tax. And especially when it comes to investors who have an option, meaning that these are foreign investors who can invest across asset class, across countries. If the country's returns are going to be attractive over the next 3 to 5 years, I think 20, 30 basis point or a 50 basis point reduction, depending on how much return you generate, is actually not going to be that big a deterrent. We did see FIIs selling yesterday, but frankly, I don't see this having a lasting impact.
But tell me more about the domestic investors, because foreign investors, of course, that the return equation tends to be quite different for them. There are other factors that play also for domestic investors, because today we care a lot more about domestic liquidity, how the high net worth individuals and family offices are going to allocate their resources, what are the alternate investments for them. From that point of view, this come down from 20% to 12% on real estate. Does it change the complexion of real estate returns? Also, this holding period for REITs has been reduced from 3 years to 1 year, and the SEBI chairman has also been saying that the REITs in this market could be 10 times higher, or even be competition to equity markets over the next 10 years or so. She expects that it could be that large. So this kind of harmonization, will it divert money away from equity markets into other asset classes?
See, the total gross savings in the economy are 30 lakh crores plus. So if you look at household financial savings at a gross level, about 30 lakh crores in FY23, and I think higher in FY24. So of which, if 2 lakh crores or 2.5 lakh crores comes into equities, frankly, it is not. I don't see this as being totally transformative. In fact, the fundamentals of the asset class should play a bigger role. Versus a 2.5% disparity. But yeah, I think from a real estate perspective, the type of investors or the type of people who buy houses. If you are buying to live, I think clearly these things have no impact at all. Even if you are investing, I think the fact that these are large transactions, these are illiquid transactions. The bid ask spread is generally wider, meaning you can't just sell a house whenever you wanted to. So the timing of that sale, the timing of the purchase, and actually, so I don't see this as being that impactful on saving. I mean, if the real estate cycle is on the up, that's enough reason for most people to actually start buying. And when it starts to stagnate, as it did between 2012 and 20, then that's the time when a lot of people liquidate. So the concern was opposite. In fact, some people have expressed a concern, and so real estate stocks sold off yesterday. You very clearly reached it much better. But the fear is that because of the drop in inflation indexation, the real estate as an asset class becomes less attractive. Frankly, I don't think so, because most investors so that most buyers are, of course, people who want to live in those houses. The investors are generally short-term holders, and so at a inflation rate of say 5-6%, the holding period of say up to 5-7 years is reasonably well protected because of the drop in the headline tax rate. So I wouldn't make too much out of this. I think this is the cycles in terms of after a 10-year down cycle in real estate, if you're seeing an up cycle, it lasts a few years. That's because the sale volumes have picked up and inventories have to be rebuilt. In equities, you have significant improvement in free cash flows, operating cash flows for listed companies. Capital share of income is going up. The growth should be better than nominal GDP. So those are much more important variables when you think about the asset class and the returns that you can expect.
No, in fact, I was talking to some people yesterday, and the view was that if you assume, of course, today we are not there in terms of inflation. We are still grappling with inflation. It's not under 4%, which is the target. But if you were to achieve that, a 12% rate is obviously better than 20% plus indexation benefit, assuming a 4% inflation rate.
Absolutely.
And now juxtapose that against the fact that in the last 3-4 years post-pandemic, we have seen such stupendous gain in the equities. And today everybody is cribbing that, valuations are elevated levels and we have to moderate our expectations in terms of returns. On the contrary, last 10-12 years, real estate has not really performed, except the last, 2-3 years after COVID, you've seen some kind of a surge. But we are still in early stages of the upcycle. So does that sort of tilt it in favor of real estate now? Because you've seen 10 years of underperformance.
Correct. It does. And to some extent, this is the frothiness of the equity markets is something that when every single senior regulator has spoken publicly about it, from the finance ministry to the Reserve Bank of India to SEBI, everyone is talking about how frothy equity markets are. In fact, some people are now, in the policymaking circles, are starting to worry that, 6 months, 9 months back, we thought there were no domestic macro concerns or vulnerabilities we had, but this bubble that seems to be forming in equities is actually something of concern to us. So, in a way, I don't know what the regulator can do or regulators can do to unwind or at least stop this bubble from building up, but. Frankly, even from that perspective, other asset classes, including bonds and real estate, as you mentioned, would make a lot more sense.
Fair enough. And what's your take on, how is this transition likely to happen? Because there are all these pockets, right? Real estate stocks is still a very small category in the stock market space. And, there are a limited number of stocks that you can play from. Given an opportunity, if you want to build, if you want to ride that cycle, it might be a very good space to invest. Direct real estate, like you said, has all this problem with respect to illiquidity and so on. And now you have REITs emerging, and the regulators' thrust is also around REITs. How do you see this transition from equities, if at all, away into real estate space happen?
No, but see, these are asset classes that have existed. They've existed in various markets for a very long time. So while I think the potential for REITs and InvITs is very strong, I totally agree. But equities as an asset class, has existed for several centuries. I would say 7-8 centuries, and right from East India Company and all that. These markets have been long lasting. So I don't see this as necessarily like kind of fading away. And I will bring back, that main objective that look, capital gains taxes are paid on capital gains. So the first objective is like, uh, if your income is say 49 lakhs versus 51 lakhs, and if the marginal tax rates are actually consistent, are you better off earning 51 or 49? I mean, that is the question. So, or if say the tax rate goes up after you cross 15 lakhs, I mean, do you not want to earn 18 lakhs? I think that's the crux of this debate. And in my mind, it's very clear. I mean, you go where there are capital gains.
No, I think from a new investment perspective, that makes sense. But I think where people have concern is that, anybody who bought real estate after 2001, and now you take away the math, especially if you're, early part of, 2000, if you take as your starting period and start to book gains, then you are a bigger loser if you are, an early investor.
I hear that.
I think that is where
I think,
people have this concern.
correct. No, that is definitely a concern. There's no denying that. But at the same time, remember that this lack of sale actually could actually boost the real estate market, right? Because then there are fewer people selling, and the number of people who want to buy are pretty much the same. So, I mean, as a forecaster for markets, as someone who needs to have an opinion on whether the economy will be helped by it or not, I don't see this as a very negative outcome. I know it is unfortunate. I mean, I would call myself one of them. That without the inflation indexation, maybe one of the older houses I have, I mean, whether I'll be able to I'll end up paying a lot of tax on it. But that's fine, right? I mean, the point is, forward looking, I think there are very few reasons to be concerned about the changes made.
Do you think the government might roll it back? Is there a possibility? Was this a much debated item amongst policymakers?
Rolling it back, frankly, I mean, I think it's the government's prerogative. But given that it was undertaken, I think this exercise of rationalization of tax rates is something that started getting discussed, if you remember, in the 2023 budget. And after that,
right,
the various senior finance ministry officials have been bringing it up. It actually was discussed again after the 2024 vote on account. And that was not clearly the right place to make these changes. So if it has been discussed so deeply, I mean, the likelihood of rolling it back seems very low. If there is a severe concern about certain bracket of home buyers, people who bought between say 2001 and 2012,
right,
and it was a period of very high inflation, that can be a grandfathering window. So maybe some modifications possibly can be considered. Frankly, I have no idea, I mean, how the government thinks about these things, but a rollback seems, I mean, at least to my mind, very unlikely.
Sure. Okay, moving on to other things. One of the things that was interesting about the budget was that they didn't change finance minister didn't change the nominal GDP projection. And the street has definitely unanimously has 11% nominal GDP growth as opposed to 10.5% that is maintained from the interim budget. Do you think the government is once again being conservative, or are there any concerns?
So to some extent,
I mean, undershooting yet again, because last year we had nearly 1.3 lakh crore difference in terms of net tax collections, right? So could we be undershooting again this year?
So this is how you build confidence of the markets, right? So you start to so this is how you add to transparency. You start trusting. See, the fear with which most of us used to read the finance bill earlier, that there must have been, I mean, there's nothing in the budget speech, but what if there are some googlies that have been inserted in the finance bill which have not been made public? And I think that apprehension that the government is predictable, is transparent, it wants to, it will very clearly talk about the changes it wants to make, is very much there. And I think an integral part of that is conservative forecasting. So in fact, not just where you mentioned that 10.5 versus 11, I think that the personal income tax to GDP is rising at nearly 20 basis points a year. And there is a possibility that the government is, again, I mean, they did bump up the personal income tax target versus vote on account, but I think there is scope for it to go up further. they have also on the borrowing side, remember that they ended the year with somewhere between 1 to 2.5 lakh crores of extra cash. So on 28th of March, they had 2.8 lakh crores of cash with RBI. And on 5th of April, they had 1 lakh crores. So somewhere between that number, right? What was on 31st March, we don't know. Now,
Right.
The government is also seeing a 70,000 crore reduction in the fiscal deficit. But the borrowing target has been brought down by only 12,000 crores. Now,
Right.
how have they achieved this? By earlier in the vote on account, they were planning to issue 50,000 crores of T-bills. Now they're saying we will absorb 50,000 crores of T-bills. So there's a 1 lakh crore buffer already on the borrowing side. On top of that, they're expecting a 90,000 crore year-end cash balance. So there's a 1.9 lakh crore. So over and above the buffers that you talked about, whether if the nominal GDP is higher and stronger, the tax collections can actually do better. On top of that, even on this fiscal deficit, there is a 1.9 lakh crore buffer on the borrowing side. So
Absolutely.
the way you bring down cost of capital and the way you stop the industry from fearing the government or from being apprehensive about this big elephant and which way it's going to stomp is by making yourself very predictable, very transparent. And I think this conservative forecasting is very much in line with that. Remember that in the economic survey, and I'm the first to say that the economic survey and the budget are two very different documents. We shouldn't try to conflate the two, even though they're presented one day after another. The teams working on them are very different. But still, I mean, given that the CEA is a trusted advisor of the finance ministry, the fact that he observed that growth will be 6.5% to 7%, and we are cognizant that this is below the current market expectations. So this conservativeness that, look, there are risks in the global economic environment, and Dr. Nageshwaran is, I think, has been a scholar of that for a very long time. So his instinct may be that there are risks still on the horizon, so it is wise to be prudent. I think those would be the factors that have gone into these conservative estimates.
Right. So in a sense, for people who've been in the stock market for a long time and watched this, finance minister is taking a leaf out of the Murthy playbook, the Murthy playbook, because Infosys was the company which really started this whole trend of undershooting and over-delivering in the initial period. So, okay. Neelkanth, the other important question is that on the consumption side, did you see any concrete moves that gives you the confidence that consumption, which has been the slowest piece in the GDP growth, of course, in the last few months, we've seen some kind of recovery there also. Does it give you the confidence that one, demand will perk up, and second, that private Capex can now start to come in?
So let's look at both in very differently, because there are different drivers to each. So starting with investments, I think the slowdown that happened between 2012 and 2021 was largely due to two factors, and there are many variables, but you can pinpoint two major drivers. The first was the downturn in the real estate market, and the second was the excessive investment that had preceded or overcapacity in the energy generation sector, power generation sector. So the decline in manufacturing Capex primarily was visible in metals, in construction materials like cement, and in machinery, which is like the excavators, the diggers, and all of that. Now so as the real estate cycle turns, and it is turning mostly because of natural reasons, and it had to at some point, that the cement companies are starting to expand capacity. You're seeing cement companies respond to 2 years of 8-10% growth by like one of the companies is thinking of doubling its capacity in the next 5 years. The larger ones are talking about significant capacity expansion as well. Steel companies, remember that last year a very large amount of steel consumed in India was imported. So steel companies are now talking about doubling their capacities. In energy, we are starting to see shortages happen at peak power, In fact, there are some people who think that the binding constraint on India's growth and how long it can sustain at 7% plus is actually the amount of power we can generate. So we are back to seeing those concerns.
Right.
And so announcements have been made. Now, they have not yet started reflecting in spend on the ground. And I think the investment cycle, as the real estate cycle continues to be quite strong, investment to GDP will rise. And I think the contribution of this budget has to be indirect, is mostly through sustaining infrastructure to GDP or Capex to GDP at a high level. I think going forward, the percentage of GDP will be consistent, and also giving clarity that the government is still focused on macroeconomic stability. On the consumption side, frankly, given where our debt to GDP is, and given that the reduction of that debt to GDP requires multiple years of very disciplined spending. So you cannot increase your fiscal deficit. You got to bring it down. You can't bring it down very fast, because if you do that, you slow down the economy and then debt to GDP goes up again. At the same time, and so to achieve that, every rupee that you spend has to be spent so wisely that it has a multiplier, in the sense that if you spend it on roads, you spend money to build the roads, that creates demand in the first year, and then the use of that road drives productivity in the subsequent years. Whereas if you spend it on consumption, so I think the scope for the government to spend on consumption was directly on consumption or boosting consumption was very limited. The state government, anyway, you must have observed, the top 10 states of India together spend now are spending 1.8 lakh crores, 0.6% of GDP, on income transfers to adult women. So the center, I don't think, had the space. So whatever consumption support happens will be indirect, in the sense that if the government is able to stimulate the job creation that it intends to, if it is able to stimulate private sector investment, which I think will happen over the next couple of years, as the real estate cycle turns and construction jobs come up, I think, and like HUDCO is borrowing some 28,000 crores, and there's a lot of push on urban housing. So all of these schemes can create demand and then income, and that will then boost consumption. But directly, I don't think there was any scope for the government to boost consumption.
Sure. The other question is, one of the things about this budget, which people were expecting that there will be a lot of sobs for, Andhra Pradesh and Bihar. And she also mentioned all these things in the budget speech. What's your take? Is this like the new reality that, do you see a substantial shift or any shift at all from the way budget making or policy making has happened in Modi first regime and the second regime versus now?
So remember that the 14th Finance Commission did away with the special category status, because I think Dr. Y.V. Reddy, who was the chairman of the 14th Finance Commission, I think his apprehension was that central governments tend to misuse the special category status or the leeway that they have in controlling the state fiscal deficits in order to favor some coalition partners, right? Because what had happened in the UPA 1 regime was that West Bengal was reporting 7-8% fiscal deficits continuously, but the center did nothing about it because the left front was supporting them. Without them, the government would have fallen. And so by doing that, he has now restricted the central government from playing favorites. So there is only so much that any central government can do. Now, what they can do, and what they have clearly signaled they will do, is start to because the location of the national highways can be decided by the central government. So, and frankly, as a Bihari, I must say Bihar does need a lot more of national highways. So, if that infrastructure is getting built, you can't have India grow if UP and Bihar are lagging behind, right? So, from a national perspective, also, irrespective of whether JDU support is critical or not, that's important. Look at the kilometers per person and all that. Bihar comes out at the bottom of the rank. So I think the spending, the prominence given in the budget speeches has been picked up by the newspapers, and very rightly so. I think that was the intention. But in terms of actual spending, the fact that Amravati can get a multilateral loan with the center's guarantee is, I think, very important. I think 15,000, but that's 15,000 crores of extra spending. Frankly, it's all getting into infrastructure. There's no money being given to support fiscal handouts or irresponsible spending. So I don't see this as a big departure from the first two governments, 14 and 19.
Okay, fair enough. As a Bihari, you might say Bihar needs more roads. As an Indian, also you have to say Bihar needs more roads.
Exactly.
I think, which will become consistent with Vilaja. Okay. Okay. One important question that all investors are asking is that the fact that Capex spend in this budget was kept at the same level as the interim budget. Definitely, some quarters were expecting that that 16%. Of course, on revised estimate it was 17%. On the budget estimate it was 11%, which looked more modest. So people were saying that it's perhaps in the final budget they might want to do something more, maybe take it up to 20% or 25%. That didn't happen. So a lot of people are interpreting that as saying that now government-led capex will not be an area of priority, and therefore you should shift focus onto other segments of the market, because that's the cohort that has really been in momentum in the last few years, right? Do you agree with that view? Should the focus now be high quality companies, consumer oriented companies, things like that, as opposed to industrials, government spend driven capex companies?
That's a misinterpretation, in my view, of government policy. So the fact is that the government has said explicitly that capex to GDP will not go up any further. Meaning the central government capex to GDP will not go up any further. So going forward, the growth in capex will be in line with that of nominal GDP. And I think there are two reasons for that. The first is that the government doesn't need to spend more, because the whole objective of the government spending is to do counter-cyclical adjustments to demand. And if steady state demand is picking up, and there is clear evidence that real estate cycle is up, people are announcing expansions for steel capacity, as we discussed, and power capacity. I mean, I think the government needs to then slow down. I think that's the macroeconomic ask. The second is that there is a limitation on how much the central government can spend politically, because under the constitution, the only areas which are under its control are national highways, railways, major ports, airports, and telecom. Now, on roads, they are kind of maxing out on how much they can really spend. If you have 1,80,000 kilometers of national highways and you repair them once every 10 years, you cannot do more than 16,000 kilometers, 18,000 kilometers of national highways in a year. So which I think we have reached, and so there's not much scope. On railways, I think the capacity to spend is growing, which is very encouraging, but it can't grow very fast. And in 5 years, I think it can reach 4.5, 5 lakh crores a year, but that cannot happen very quickly. On telecom, they've already given a lot of funds to BSNL. BSNL now has to launch the network by Diwali or end of this year. And then we will see even how it starts to prepare for the next 5G investment. This is just 4G stuff. On major ports and airports, frankly, it's very hard to spend a lot of money. I mean, airport is like a runway with a building, right? I mean, how much money do you spend on that? So the ability of the central government to spend on infrastructure is also constrained. I mean, defense, there is a pace at which the defense projects move. So I think it was unwise to expect that the government will keep accelerating that now. I think the industrial cycle or investment cycle moves into a stage where the private sector is starting to step up. And that's why I don't see this as necessarily a point in the market where we turn our portfolios.
No, by that logic, we should be, right? You're saying that ability to spend more is limited, and therefore the big pop in order book that we got for railway companies, defense companies, etc., is now maxing out. So we have to wait for the next round of capex to happen from the private sector for us to keep faith, and that would be a very different set of stocks.
That I agree with. That I agree with. In fact, on the defense sector, my view was that, and I've been saying this for a while. We did my colleague who covers industrials and defense, I mean, he said We did the whole mapping of the market and found that it was a 1 lakh crore market with potential growth of 15% after including indigenization, after including export growth, after including everything else, and privatization and all that. So how much do you want to pay for it? So that, I think, is, broth, and that has to correct. In railways, there's a pace at which railway Capex can grow. The expectation that some of these stocks will be trading at 100 times earnings was ridiculous. So, but for industrials as a sector, I think the fact that a lot more construction needs to happen in India, and frankly on the infrastructure side, which is why the medium-term outlook is going to be dependent on how deftly the government can manage flow of funds to urban administrations. So India needs to really, really get cracking on urban infrastructure, not just coastal road and metro rail in Mumbai, but do it for 500 or 1,000 cities. And that's why it's so interesting to me that the finance minister's speech prioritized urban development, expansion of brownfield cities, or development of brownfield cities. And therefore, as we start to see clarity on how that funding will occur, will there be big changes in the 16th Finance Commission and how the fund allocation happens? But in the interim, so urban infrastructure clearly needs a lot of government spending, but that can't be the central government.
Right.
To be the local governments, not even the state government. So, but on the private sector side, I do see demand coming up. So my preference would remain for industrials as a sector, but I'm with you that there was froth on railways and defense, which perhaps is justified.
Fair enough. One final question. Pick out 3 pockets of opportunity for you in the stock market right now. I'm sorry, the question I was about to ask is risks, actually. What are the top 3 risks that you see for markets? So you can answer both.
No. So actually, let me focus on the risks. I think opportunities, once you hear my risk, you will realize I don't see many opportunities. So, so the risk, I think the first risk is that the period of acceleration of growth expectations is behind us. See, meaning that, in January last year, we had expectations that GDP growth post-pandemic will slow down to 5.5% or 5%. Now we are at 7%, and some people are saying, can we do 8%? So I don't think we can do 8% if the global economy is so slow, and therefore I think the likelihood of further growth upgrades from here is very low, and which is generally that inflection point is not explicitly stated anywhere, but is very important in terms of price to earnings for the market. So that, I think, is a risk. If our growth acceleration slows down or rather doesn't happen any further, I think the PE multiples need to correct from here. The second big risk, in my view, is what's happening in China. In fact, if you ask me on the industrial side, this is my biggest fear, and is something that the economic survey also talks about, is the excessive investment that China is making and the response that it is triggering from the developed economies, which are recipients of Chinese exports. And so the scale of investment is absolutely mind-boggling. The increase in loans given to industry in the last 4 years is $1.9 trillion. For India, the total banking system loan book is $2 trillion, right? So the scale of investment is mind-boggling. The third is, I think, the political risks and the geopolitical risks that emerge from what's happening in the US in terms of the political shift and the fiscal policy of the US. So just like in India, the growth estimates for US economy have been upgraded. US economy's growth upgrades helped the overall world economy as well. A large part of that, in my view, was driven by expansion in fiscal deficits, which is now slowing down. So if you look at 12-month fiscal deficit over 12 months, the same point last year, that impulse has come down from 5% of GDP, which is ridiculously strong, to less than 1%, and in the next 3 months will slow down to negative. And I think that slowdown is not yet priced into the markets.
Fair enough. So that's a scary picture, actually, because you're talking about earnings growth slowdown, you're talking about risk from global factors, etc. So pockets of opportunity.
So when the real estate cycle turns, I think the domestic, so we have seen a bit of a lull. So cement volumes have been weak in the last couple of months. There was, I think, a slowdown in government spending, plus I think uncertainty around who comes to power and what happens and all that. So I think there is an opportunity in proxies to domestic construction. And I also think there are opportunities in the financial sector, which versus its own history is actually trading at reasonable multiples.
Right.
I also think that the energy cycle will run much stronger this time than is currently priced in. So we have seen those stocks do extremely well, but I think the positive surprises on energy demand are not done yet.
Sure. Thank you so much, Neelkanth. It's always a delight talking to you for all your insights. Thank you so much.
Thank you, Maharashtra. Thank you for having me.
Bye. Thank you so much for watching us.